Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. We're going to roll through Twitter, do our kind of quote daily update from Twitter almost. Um, it's just a bunch of news, bunch of information that's financial topic related or commodities or wealth building topics. So we're going to dive in here. I'm going to give you a whole bunch of my financial opinions as we go. And again, if you want to follow me on Twitter, it's at finding_finance, or you can join the website, finding-value.com, and subscribe there and join our community. We do have a 7 a.m. Mountain Standard Time Saturday session, which is actually occurring right now as I speak. So, Octavo Tavi, he says, the percent of yield curve inversion is surging again, now back above 90%. That is happening in combination with the flood of U.S. debt issuances. Credit markets are speaking loud and clear. And a lot of the times when you get this percent of yield curve inversion, we usually get a problem. Inflationary bust, double dip recession. So that was 1980. This one here is early 1970s, S&L crisis. But I do want to say something here, all right? All of these busts here, outside of the tech bust, these were all housing market busts. Housing market bust, housing market bust, housing market bust in 1990, housing market bust in 2006, 2008. So that's a housing bust, housing bust, housing bust, housing bust. This one was not a bust. This one was a mid-cycle wobble with increasing interest rates that blew up the tech bust. We've got the COVID recession, which is kind of, I'm going to say, unique in its own. And this guy here, that is what we're trying to figure out. Is this a housing bust, which in my opinion is not? And I think it's more like the tech bust. So it's going to be the oddball out of all of these. Well, I'd say COVID recession is also an oddball. And the reason I say that is we have not built the homes. We've got a deficit. And I know I go back to that. Why is that so important? Because everything I look at is through that lens. These busts are from housing market busts. And that's kind of, we're in a weird situation right now, which is much more similar to the 2000 tech bust. So I think that we could come back down. We could have a recession. That could all happen. But I think we'll come back up just like we did in 2005 and 6. So I think that is what would happen again. But time will tell. Good chart there. We've got heavy truck indexes approaching turnaround levels. Every time this indicator collapses, equities fall rapidly. So we're at a very high level for this heavy truck index. We're way up here. And it's, for some reason, he says every time we come up to this level, it turns around and we get a pullback. Now, this is the COVID crash right here. This here is the housing market bust, and this is your tech bust. So are we going to get some sort of turn in a lot of these indicators that is going to be driven by some sort of slowdown or recession? I don't know. And we're going to have to find out. So, I mean, that's the data right there, and that's what we're seeing. What does Dr. Copper have to say? So generally speaking, in a bust type scenario, you'll see copper fall off a cliff. So this is 2008 falling off a cliff. We grinded slower here over time in this copper price here in the 1990s. So that was 1995, and we broke out in 2003 or 4. Looks like 2003 we broke out and went to the next level. We went up to this next level. We went higher here in 2019, 20, 21. Kind of peaked out in 22, and we're starting to come back down. He says stay clear until this is closed above this kind of structure that's created. Huge volume defined base right underneath us. Maybe we come back and test that base there with that volume. But I know that there's shortages out in the future of a lot of these different commodities. I know that there's a deficit in the home market, which is inflationary. Actually, it's all inflationary. So the way that I view it is rather than trying to time the short-term market movements, I try to position for the long term. Now that's just me and what I prefer to do. Other people can try to trade this. That's all up to you. But I like the big long-term, big picture view stuff. So he's thinking maybe we're back in 1997. What that would indicate is that we're actually before the bull market by 2 years or something like that. I don't know if we're that far back. The reason is the commodity to stock ratio was still falling during that time frame. And we've broken out of that downtrend to the upside. So I don't think we're that far back. If I were to guess, I think that we're actually over here in 2001 or something like that, where we could still be falling down in 2001. We have to gather ourselves in 02, and then we'll start to move up. So maybe we come back down, we gather ourselves, and then we break out. Something on the lines of that is probably my best guess. But again, I don't go off guesses. I just ride it. Just ride it and accumulate it as we go of cheap assets. Coming down 3 weeks into June, Russian crude exports are actually falling. So we've got a decline in Russia crude exports. Looks like it's, I don't know, maybe 500,000 barrels a day or something like that is what we're declining there. Lance Lambert says, Bank of America, low inventory in the existing home market has acted as a floor for prices, keeping prices elevated relative to pre-pandemic levels despite the decline in sales. BofA insinuates that national home prices have already bottomed. Wait, bottomed? So let's read this. It says the S&P CoreLogic Case-Shiller National Home Price Index likely grew 0.1% year over year in April, cooling further from the 0.7% year over year growth seen in March. Annual home price growth has been slowing since early last year. However, it appears that prices may be nearing a bottom as the home price index has recorded 2 monthly increases in February and March. Low inventory in the existing homes market has acted as a floor for prices, keeping prices elevated relative to pre-pandemic levels despite the decline in sales. Well, that's their opinion. I don't really hold anything, like it's not like that's a big deal. And it's not like, oh my God, they have an opinion. Holy crap, it matches what I think. Doesn't really matter, guys. The market's going to do what the market's going to do. When you look at the data, come up with your own conclusions. My conclusion is low existing inventory is going to force home buyers into the new home market, which is an expansionary phase of real estate. Now, the affordability is what's slowing the market down. That's what's slowing these home sales down. If those interest rates were to come back down for whatever reason, I think that the market's going to heat back up again. And it's going to kick back on inflation. That's my take. Coming on down, it says chart of the week. How the hell are these companies going to scale when they couldn't make a profit in the peak easy money, ESG, and subsidy era of 2020 to 2021? So this is the net profits of major wind turbine manufacturers. They had a little bit of profit in 2019. 2020, they started to go a little bit negative here. And then 21 and 22, well, they're all going kind of negative. So how are we supposed to scale this stuff if none of these guys can make any money? Good question. I think solar's in a similar spot to wind. The inverse correlation, gold versus the United States dollar, can be strong shorter term, but longer term, it is not an issue, as the ratio chart shows. When this breakout happens, the opportunity will be generational, a rare event that does not come around many times during a lifetime. Preach on, Grady. So this is gold versus the US dollar. We've got, when this ratio moves up, gold outperforms the USD. You can see a pullback here, kind of an A, B, C correction, and then we just rip it. We've got an A, B, C kind of correction going on, and we could break on out. So it's been consolidating for 12 years. Should be time for another big breakout, looking at the similar red pattern inside the triangle. Time for another long period when gold outperforms the US dollar. So we haven't gone straight up. We can see that we had massive pullbacks here in the early 2000s in gold. Many pullbacks. We had a monster pullback in 08. We peaked ultimately in 2011. Are we going to get a massive move on up where we get this gigantic stair-stepping pattern? I think so. I think the market conditions are there. This here was a housing market boom in the 1970s. We pulled back. We had another 1970s boom. We went into a consolidation period. Then another big old boom. I think a big boom's coming in gold, silver, precious metals, and commodities all across the board. And these charts are evidence of that occurring. It's the herd setting this thing up for a big move to the upside. Here's SRS Rock Report. He says, draining the strategic silver reserve. While the world is focused on draining of the U.S. oil SPR, Strategic Petroleum Reserve, the same thing is happening to silver. With solar PV demand forecasted to double by 2025, there just isn't enough silver. You have silver. It says draining the strategic silver reserves. Here we are draining them back down to very low levels. So what's going to happen? I don't know. Again, I'm positioned in this stuff, and I'm just waiting. I'm waiting, and the first step that you have to do is you draw down your inventory levels. That drawdown of inventory puts you at very low inventory levels, and then the price really starts to move. When the price starts to move, what that does is you go into what is called an expansion phase. That expansion phase is where you expand into new mines, you expand production of new things. And that is what happens. That's the cycle. You draw down inventories first, you get to very critical low inventories, the price goes up to spur on new production or supply. That is of anything. That's the cycle, and that's where we're at in the cycle. And we're hitting these very low inventory levels across the board of a lot of different commodities. Silver, platinum's running big deficits. We've got uranium running deficits. We've got oil that is suspected to run deficits. And I know they threw the whole SPR at it when we were running deficits. Right now, it's calmed down some in oil. That's why we have a little bit of a cutback in OPEC, and then we'll see what the deficits do in the second half of 2023. But that's the cycle, guys. It's coming. Big global inflation always starts with and is driven by commodities. This chart shows how undervalued copper is. It's a hard asset, and how overvalued the NASDAQ is, a paper asset. When this chart starts to move, the second inflationary wave starts. It's the third wave, but it's the second inflationary wave, up wave. We've come all the way down. We were at critically low levels in 2000. Big bull market from 2000 all the way up to about 2011. We came back down, and now we're at a very low level again. This is your booty bottom. Boom, boom, and then we can get that big move to the upside. It just takes time, guys. This is a very big, very long-term chart. It's a 45-year chart. So I think that the next maybe decade is going to be a big move for commodities, copper, whatever it is. And he agrees. Ferg says, one of the great trends to play for the next decade is electrification. If your minds jump to EVs and heat pumps, that's not what I'm seeing or saying. As those generally go hand in hand with countries screwing up their grids with renewables. I'm talking about developed countries' AC, or so developing countries' AC demand. Global air conditioning stock from 1990 to 2050. Look at how fast this goes up, guys. This here is growth for copper and electrification above and beyond anything that electric vehicles and renewables are going to do. The growth is there irrespective of what you look at. It's air conditioning and bringing those countries' grids up to speed. Here's Patrick Karam. It says the current gold, silver, and oil price action might be trying to tell us something is about to happen. This Bank of America chart is primed for a major fall down. Hold your breath. And Bank of America, I've talked about this before. You've got a long-term uptrend. We've broken that to the downside. Is this thing ready to crash? It could be. Could we see a big crash in Bank of America? We very well could. We could also come back up, do a retest before doing that crash. But it's not looking good. And maybe that's why the markets are pulling back some. Maybe that's why. And maybe we've got some bigger problems in the market that are out there. So, coming on back, we've got Bank of America, again, Uselink's talking about it. The banking sector never really healed after the 2008 GFC, never got back above 2008 highs or 2006 highs. Bank of America is on the verge of a major breakdown here. The trust in the banks are diminishing. And here is a potential breakdown that we could see in Bank of America. And we're in that upward channel at the moment. Eric Nuttall states, there are two markets for oil. The physical market, which is the largest commodity in the world, and the financial or paper market for oil, which is 30 times bigger than the physical market. There could be times when the physical market's healthy as measured by inventory trajectory, yet the financial market for oil is weak due to things like fears of recession or regional bank failures. Given this 30-to-1 ratio, the tail can wag the dog, and weakness in the paper market can temporarily overwhelm positive underlying fundamentals in the physical market, leading to price falling below what can be fundamentally explained. If we are directionally accurate in the magnitude of the inventory draws coming in the second half of the year, we believe the strength in the physical market will overwhelm the unbelievably negative sentiment in the financial market for oil. Maybe that's true, maybe that's not. What I do is I try to remain neutral, and I just ride on through this bad boy. We are very cheap on a ratio perspective of the oil to gold ratio. So what I do is I stay long. This very well could be the case that we are strong in terms of the physical markets versus the paper markets. But the paper markets at this time rule the price. And that is what it is. So, yeah, that's what I'll say there. And that's where I'll end it, guys. That's what I've got for today. Hopefully, you guys enjoy the content. Give me a thumbs up if you do. That's really all I've got, guys. If you enjoyed it, give me the thumb up, subscribe to the channel, subscribe to the website if you'd like. And we'll catch you guys later. This is Finding Value.